I was already planning on doing an oil show for you guys on Saturday, and we go and we get some more crazy news. I was planning on actually just covering how earlier this week the Russian central bank did research and released it and announced that they're preparing for the possibility, the extreme possibility, that oil prices could fall to $25 a barrel in 2020 based on their global macro forecast for reduced global growth, reduced demand, etc. The risk scenario could be triggered in case of lower demand for energy products around the globe and worsening prospects for global economic growth. So, today, I will talk about the oil market. I will give my insights into that, but literally crazy stuff is happening in the last 12 hours. According to a number of reports, I have up this article from International Oil Daily that was shared by Shy Girl, who is a commodities trader on Twitter, and also Danielle DiMartino Booth. So they're the Energy Intelligence Group as the parent company, the International Oil Daily. This article came out earlier today. Attacks knock out over half of Saudi oil output. Aerial attacks knocked out more than half of Saudi Arabia's crude oil production on Saturday, and it was unclear how long the outage would last. National oil company Saudi Aramco and oil minister Prince Abdulaziz, hopefully bin Salam, both said an estimated 5.7 million barrels per day of crude oil output had been taken out by the attacks. Quote, work is underway to restore production and a progress update will be provided in around 48 hours, Aramco said in a statement issued late on Saturday. Neither Aramco nor the minister provided an estimate of how long it would take to restore production. In Washington, the White House said the U.S., quote, strongly condemns the attacks and that President Donald Trump had spoken to Crown Prince Mohammed bin Salman, to offer his support for Saudi Arabia's self-defense. The Department of Energy said the U.S. stands ready to release oil from the Strategic Petroleum Reserve if it is needed to offset any disruptions to oil markets as a result of the attacks. The reserve holds approximately 630 million barrels of oil. Let me take a sip of my beer. Prince Abdulaziz told the official Saudi press agency that attacks on two major oil installations resulted in a temporary suspension of production operations. The minister told the agency that Aramco will seek to keep up oil deliveries to its customers by drawing down oil it holds in storage. The strikes against the crucial oh my god, I'm going to screw up this pronunciation, ABQAIQ, Abquake processing complex and the country's second biggest oil field, Khurais, were claimed by Yemen's Iran-aligned Houthi rebels. A Houthi spokesman told the movement's Al Masira television channel that the 10 drones were deployed and that the further strikes could be expected in the future. Official Saudi statements did not mention drones. Aramco spoke of attacks with projectiles. The events on Saturday highlight the kingdom's vulnerability to attacks by drones or missiles, which have struck Saudi infrastructure several times this year, including the country's east-west crude oil pipeline in May. They also come at a sensitive time for Saudi Arabia, which has recently replaced its oil minister and the chairman of Aramco as it presses ahead. Fast tracks because I will add here fast tracks because they need the cash. Several times. As it presses ahead with the company's long-delayed initial public offering. I was going to question why Saudi Arabia, before this announcement came out about the attacks on the Saudi oil field and also the large refinery in Saudi Arabia, why Saudi was trying to sell Aramco now when oil prices, when we're doing this live stream show, oil prices are, WTI is below 55 at $54.85 a barrel. Brent crude is at $60.22. I suspect that there will be a spike on Monday. I don't know how much. It may only be temporary for a couple days, couple weeks, maybe a couple months, a spike, because the oil market prior to this news, the oil market was in a clear bear market. It was very clear bear market. So there's people out there saying this is a false flag. Maybe it was a false flag. Who knows? I think there's evidence. I've listened to a lot of macro voices over the years, in the last couple years, and Eric Townsend was talking about last year and the year before, especially last year, for a lot of 2018, how in the oil futures market, there was when oil price was rallying up to $70 a barrel, there was, in different parts of the curve on the futures market, there was big short positions developing, and his thesis was that there was the Saudis or OPEC were shorting futures contracts to set up the shale producers for a crash. And the oil futures market, if you're not familiar with it, there's no position limits. It's not enforced like gold and silver. So there is the opportunity for a lot of manipulation there, just like gold and silver. In fact, there's opportunity for even more manipulation because there is no position limits. Although gold and silver are very heavily manipulated, the oil market is also manipulated. I remember when I was an oil analyst, this was my day job in 2013, and the Saudis were... I was reading comments from the Saudi Aramco CEO and Saudi's oil minister, and they were talking about production costs for shale, and they were refusing to cut production costs. They were refusing to cut amount of barrels produced, even though the market wanted OPEC cuts and Saudi to cut, and they were refusing because they were trying to kill shale oil. This is when oil was falling from 100. It was over like a 2 or 3 year span. Saudi really tried, I think from 2013 to 2015, the Saudis really, and OPEC really tried to kill shale, to stop all the production growth. And they managed to get the oil price down, but shale didn't die. There was obviously bankruptcies, but the majority of shale producers didn't die because they were still able to raise a lot of capital back then. And they were also lowering their costs. There wasn't a lot of free cash flow and profits for a lot of shale producers, even when oil was at 90 or 100. But the shale companies did survive, and I think that's was a win. And the Saudis were upset with that, how many shale companies survived. So to say that it was a false flag and that the Saudis want the oil price up, I think the Saudis do want shale gone because it's taken out a lot of market share. Shale has taken away a lot of market share from OPEC. So even though the U.S. doesn't have a lot of that, oil production isn't economic, the U.S. still has an enormous amount of oil production, and that's taken away a lot of market share. So we may get, this is not financial advice, just my opinion and educated guess, we may get a 10% pop in oil, soon as markets open on Monday. Maybe more than 10% by the end of the week, we'll see. It'll be interesting, but I think long term, at least for now, oil was in a bear market. The oil price had gone down from 70 down to high 40s, low 50s, and was stuck there. And if you looked at the share prices of the oil service companies like Schlumberger, you looked at the share prices of U.S. shale oil producers, you looked at the share prices of the deepwater offshore companies, it looked to me like clear bear markets and, bankruptcy risk for a lot of these companies. So maybe this will give some of these companies a temporary reprieve, but I just don't see these companies being able to go out and raise a lot of capital. And it was a head scratcher for me why the Saudis would want to fast track an IPO for Saudi Aramco when the oil market looked like it was in a bear market, because then they wouldn't get the best price for selling that equity stake. Now, it seems clear to me they do need the cash. But this goes back to my views on the oil market. I did a video on this about 2.5 years ago. You can look it up in the archives. It's called Why the Oil Market and the Global Economy Needs a Goldilocks Price. And if you're familiar with Goldilocks and the Three Bears, the story goes that Goldilocks wanted porridge that wasn't too hot and not too cold. And really the global economy and all the players involved in the oil market need an oil price that is not too high and not too low. But the reality of the situation is the oil market never stays in the $60 to $80 per barrel range, which is those ranges when oil is like 60 to 80 or 85. Those are prices where the consumer is not hurt, especially in the United States. The consumer is not killed with a higher gasoline price, unless you're in California. But there's nothing you can do about that with lower. Even if oil prices are lower in California, you still don't get a lot of benefits from that. You're still getting killed with all those extra taxes. I think it's over $1 per gallon now in taxes now in California. It's insane. It's absolutely insane, and I'm sure they'll come up with more taxes for that. But back to my Goldilocks oil price thesis. If the oil price gets too high, it acts as a tax on the global economy. So triple-digit oil, the consumer loses discretionary income, people don't drive as much, maybe they carpool, People don't buy SUVs, so that hurts the auto company. And so a higher oil price acts as a tax on the global economy as well. Very similar to the Federal Reserve and other central banks raising interest rates. So a higher oil price, in my opinion, is a tax on the global economy. Now, a higher oil price is good for national oil companies, but it comes at the expense of many other countries in the global economy that consume a lot of oil. And then also a higher oil price, you would get more supply coming online, and then that would lead up to from the boom part to the bust. And in the low oil price, if the oil price is, say, in the 50s or below, in the low 50s or below, God forbid it goes to that $25 per barrel number that Russia is preparing for, then you would have a scenario where the oil producers, so either the private ones would go bankrupt with leveraged balance sheets and they couldn't lower their costs enough, they couldn't sell assets to raise cash, they had too much debt on their balance sheet, or the national oil companies, like a lot of these OPEC members, they would be in trouble. So a lot of these countries, whether it's Saudi Arabia and others, they can produce. Saudi Arabia, the production estimates I've seen, Saudi Arabia can produce oil at around, they claim it's $10 a barrel still. I don't believe them. Most of the credible ones I've seen are around $30 per barrel now as their production costs. So they technically can make a profit even at low oil prices now in the $50 to $60 per barrel range. However, the problem is a lot of these countries, whether it's Saudi Arabia, Iran, Venezuela, so many of these oil producing countries, the majority of their revenue, the majority of their trade, the majority of the way the countries make money is from oil revenues. So a country like Venezuela, where I believe 90% or more of all their total ways to earn dollars and government revenues is from oil, because the economy is not doing well. And when an economy is that reliant on oil, a fall in the oil price really hurts the government budget. And Venezuela is not reinvesting any profits from their oil industry back into upgrading their refineries, going and finding more oil, lowering oil costs. They're not doing any of that a private company might do. So the Saudis have needed the global macro analysis for the Saudi oil, for Saudis and oil, is that yes, they can produce oil at a low cost. Yes, they are still profitable now at current oil prices. The problem is that the Saudis have promised a lot of social spending programs inside their own economy, and they need a higher oil price. The estimates I've seen are $80 to $90 per barrel per year, so the Saudis don't have to blow through all their sovereign wealth fund. So they don't have to blow through all their sovereign wealth fund to fund those social program spending and fund their government budget. So the Saudis need oil at at least $80 per barrel, $75, $80 per barrel minimum to fund all those items without dipping into their sovereign wealth fund. And remember, they've had to dip into their sovereign wealth fund a lot over the last 5 or 6 years. And there's an interesting thing that I remember a while ago that someone brought up to me again, I'd forgotten about it briefly, is called the export land model. This is from the peak oil people. It's Dallas geologist Jeffrey Brown. And a lot of these countries, guys, where their oil is so much of their revenue, a lot of these countries, go and look up with charts the amount of oil consumption these countries have increased by. And then you get into a situation where Mexico used to have the Cantarell oil field, and they were enormous net oil exporters. They were producing massive amounts of oil. They had a lot of extra trade surplus coming in, a lot of profits from that oil. Their government budgets were funded a lot with oil money. And there's been so much increases in consumption in oil within the Mexican economy that now Mexico, I think, in the last year or two, has gone from a net oil exporter for decades since the Cantarell oil field. It was a super major oil field that was found in the 70s. They've gone now from a net oil exporter to a net oil importer. And this is the danger that cheap oil and big oil discoveries, these countries where all their government budgets are based on oil production, then they subsidize oil to their own citizens, and so many things are all based, so much government spending and social program funding is all based on profits from oil. They don't have a diversified economy. And other countries have fallen the same victim as Mexico recently, you had, I believe Indonesia was a member of OPEC, and they were kicked out of OPEC because they went from a net oil exporter and a big oil producing country. They still produce oil quite a bit, but now they're big net oil importers now because they had such subsidized cheap oil prices for their own citizens. So all these crazy things, oil, before this Saudi news, guys, I was going to lay out the case that, if the global economy got worse, and which is what we're seeing with the data, and the U.S. economy hit recession, we could have easily seen an enormous bust in oil. I think we will probably see an enormous bust in oil still, probably in 3 years or less, maybe even less than 2, but things may have been slightly delayed now with the Saudi news. We may get a pop here in oil prices. Zero Hedge ran an article saying $100 oil quickly. The oil price would have to double. I'm not sure, almost double. I'm not sure if we're going to see that. So we'll see what happens, how quickly the oil production in the refinery, if there's major damage. I was looking on Twitter. People were looking through satellite images at smoke. Some people were theorizing, speculating that the refineries were damaged with the attacks, but other people were saying that the part of the refinery could have just been shut down as a safety precaution and that they're flaring off some natural gas. So we don't know yet. It's too early. You think I'm wrong about oil? Inflation will pick up and take oil with it. Yeah, and at a certain point, Free Living Project, that will crash the global economy. If we get $100 per barrel oil, it will crash. If the global economy hasn't already crashed, it will. The U.S. consumer, there's a lot of evidence. The U.S. consumer is already strapped. A big increase in oil and gasoline will mean the consumer will stop a lot of discretionary spending because the money will have to go to oil, will have to go to gas for their cars. Big increases. So I talked about some of the problems with shale yesterday in yesterday's podcast. There's 3 articles that I mentioned. I didn't read them all. That the U.S. shale firms cut budgets and staff as oil price outlook dims. The shale boom has turned bust. Producers slashing capex budgets. A lot of people getting fired. Rig count is down 14% from a year ago. And a lot of companies are cutting their workforce in the shale. And just look at the share prices of the oil service companies, because those are the drillers. Those guys get hired by the shale oil producers to complete wells. A crash in the economy won't necessarily mean a drop in oil prices. Stagflation, maybe. Maybe there would at least be Free Living Project. At least there would be a temporary drop in oil prices. Look what happened from 2007 to 2008. The oil price went from $147 a barrel, along with the financial crisis, down to $29 a barrel. And the oil price at 147 helped accelerate the crash, in my opinion. That was one of the things. Besides all the derivatives and the mortgage-backed securities and the housing bubble and the leverage with the banks here in the U.S., the higher oil price did cause problems. So the global economy needs a Goldilocks oil price. It can't go too high and it can't go too low, but it rarely stays there because the oil market, because of the paper futures market, and the oil market is manipulated. The Saudis did try, it's clear to me, for at least a 3-year span, they tried to really kill shale from 2013 to 2015 and failed. They killed some shale, but a lot of the shale companies survived, and Saudi was very pissed at that. And I believe if you go back and listen to old Macro Voices podcast from a year ago, Eric Townsend was talking about how the structure in futures contracts on the curve for oil, the long-dated futures contracts for years from now were changing. So he was talking about someone, when oil prices were rising, initially there was a large amount of open interest betting on higher oil prices about 2 years ago, and then oil prices rose. And then he said he was noticing a big change in the structure of the futures contracts, that someone was betting on a big crash. And there's no position limits in the oil market. And the Saudis are obviously in tight with the American government. So I don't think they're going to get busted for manipulating the oil market. Maybe they'll get fined. Thank you for the super chat, Tarkinas. I appreciate it. Commodity prices like gold can't move if the dollar can't move. No, I disagree. In a crisis scenario, Timothy, the dollar and gold can both rise. In a really acute problem in the global economy, the dollar and gold can and will both rise. It's happened before. I covered this about 3 or 4 months ago in a short video. If the dollar and gold can rise together, normally it does not last for a long period of time. Normally it lasts for at most 6 months in a crisis. Normally the dollar and gold only rise together for short periods of time. Normally it's between a couple weeks to at most 6 months. It does not last a long time normally. Yeah, I could. Will this affect gold prices? Good question, Lee. I think it will. I think we could see a move up in gold. Historically, when there's a big problem in oil or geopolitical tension in the past, you would see oil and gold both rise together, and you would see a correction in the stock market. But in today's manipulated high-frequency trading algorithm market, who knows? Thank you for the super chat, Matthew M. What are my thoughts about record low discoveries the last few years? Matthew, are you talking about oil or gold or another commodity? Okay, so this export land model, it talks about it with geologist Jeffrey Brown, building on the work of others. It used to be discussed on this old peak oil website called the Oil Drum. The peak oil people weren't wrong on everything. They were right on quite a bit of things. We're not running out of oil, but a lot of these countries that were net oil exporters are now net oil importers. So they did predict these things. The export land model is important to petroleum importing nations because when the rate of global petroleum production peaks and begins to decline, the petroleum available on the world market will decline much more steeply than the decline in total production. And it models the decline in oil exports that result when an exporting nation experiences both a peak in oil production and an increase in domestic oil consumption. In such cases, exports decline at a far faster rate than the decline in oil production alone. So Mexico got hit with this. Mexico can go on the international markets and buy oil, but then that means, guys, that they need dollars. They need to earn those dollars to do it. When it used to be easier for Mexico because they were producing their own oil, and then they were I believe Mexico was subsidizing oil. I used to hear stories about people in Texas and Arizona that were driving across the border to go fill up on gasoline in Mexico and then cross back over the border because of how much cheaper gas in Mexico was. I've been hearing that from people in Texas for a long time. It could be a false flag to drive oil prices up, but like I was saying, Daniel, that the Saudis, it doesn't make a lot of sense because it looks to me, based on what Eric Townsend was talking about with his analysis for the last year and a half, that the Saudis were building, either OPEC or the Saudis were hiring Wall Street investment banks to build up a short position in oil futures contracts, and they were the ones who helped engineer oil prices lower. They wanted to try to bankrupt Shale once and for all. So it doesn't make a lot of sense because they haven't bankrupted the shale companies yet. It's just there's a lot of things about the oil market that are very curious geopolitically. There's a lot of manipulation over the years in the oil market, whether it's the Texas Railroad Commission in the past, OPEC, and others. There's no position limits in the oil futures market. Okay, Matthew, thank you for the super chat. Record low oil discoveries. So let me add your questions up here together. So what are my thoughts about record low oil discoveries the last few years? Yeah, I mean, it's long term, it's a problem. In the short term, there's a lot of oil production. The U.S. shale oil, Matthew, is subsidized. A lot of the shale oil and all this, there's a massive increase in production in shale oil. A lot of this shale oil production, Matthew, is not economic at all. Okay, it's been subsidized totally. The shale oil producers have not had to generate earnings, free cash flow, pay dividends. They promised their shareholders that, and now they're being held accountable. But for 10 or 11 years, they... Oh, this beer is making me burp. But for 10 years ago, they were not... for the last 10 years, they were not held accountable at all for being responsible stewards of capital. Pension funds... Someone sent me a message about my comments on pension funds. Look, a lot of these pension fund managers, guys... The pension funds routinely get fleeced and raped, and if you want to not be kind, they got raped and pillaged by Wall Street investment banks, hedge funds, and private equity, and also shale oil CEOs who lied to them, and they wrote big checks and bought junk bonds and bought shares. So they financed unprofitable stuff, and maybe they made some capital gains, but they didn't make the dividends or free cash flow on any of the promises that the shale oil CEOs were promising them. Low oil prices will restart the world economy. That's a good question. Low oil prices help consumers, but I talked about this yesterday. Go and listen, Jack, if you didn't already, to my show yesterday from Friday, where I talked about that, yes, low oil prices are good for consumers, but that also means big job losses here in the U.S., in North Dakota, in Texas, Oklahoma, and that would... In my opinion, that would mean so many job losses, both directly to the oil industry and also indirectly to all the service jobs like restaurants and shop owners around the oil area, where the oil workers, people working in the petroleum industry, would spend. And that means recession. That would accelerate a recession. There would be so many job losses because a lot of the jobs that were created since the 2008 financial crisis here in the U.S., they were tied to, if you go back and look up the sectors where the majority of job growth was, it was in restaurants, retail, and oil and energy. Someone's saying $18 a barrel oil. If we go down there, everyone's going bankrupt. At $18 a barrel oil, the Saudis can't even produce at that price. Jonathan, I discussed at the beginning of the show that in the short term, the oil price will probably go up unless the U.S. floods opens up the strategic petroleum reserve and sells a lot of that oil. So we'll see. But yes, my educated guess, not financial advice, my educated guess is that this week we'll probably see at least a 10% move up in the oil price. We'll see, though. If it doesn't go up, my educated guess then would be that the U.S. opens up the strategic petroleum reserve and tries to prevent that, because Trump is very acutely aware. Trump has talked about this. President Trump has in many of his tweets. He has talked about that the U.S. consumer, his voter base, needs low oil, because he is worried that a high oil price will accelerate a recession, will mean less consumer spending, less discretionary spending. There's a couple good articles. I'll highlight them now briefly, and if you want to go more in depth on this, you can read them for yourself from Seeking Alpha. They came out in the last couple days. It's this good oil analyst named Vladimir Zernov, and he is tracking the problems with Transocean and the other deep water drillers, and he's been predicting enormous problems with the deep water drillers for a while. So take a look at these articles. He's talking about how Transocean, when oil was at 70 late last year and early this year, Transocean did a $2.7 billion acquisition, betting that that was the bottom in oil prices and that oil would go higher. And so they went out and bought another deepwater offshore drilling rig company that had better equipment, and they spent $2.7 billion of their cash and their shares to do the acquisition, and a lot of those rigs are not generating the cash flow. They had to shut them down. So the rigs are going to take up to $100 million per rig to restart. And it sounds like he's putting good analysis out there. Sounds like what I read through his articles, that Transocean either is already out of cash or they're close to being out of cash already, and Transocean is living off their credit card now. They're living off their revolving credit facility, hoping and praying that the oil price doesn't go lower. Meanwhile, the management team at Transocean is saying that they think that the oil bottom is in and that oil is going to rebound strongly. But if you look at the articles that I was talking about, the 3 shale oil articles, and you look at the share prices of the shale oil producers, and you look at the shale price, and you look at the share prices of the oil service companies, things look like a very dire bear market. Look, the oil price isn't at $30 a barrel. The oil price is still in the 50s and 60s, and the share prices for a lot of these shale oil producers and the service companies like Schlumberger, the share prices are very, very low. They're acting as if the oil price is already at $30 or $40 a barrel. Wall Street doesn't let oil fall for long. No, I think Wall Street tries to keep a balance between too high and too low. Ideally, the sweet spot for oil prices where the producers can still make money and the consumers don't get choked to death on high gasoline prices, and the oil price doesn't act as a tax on the global economy and U.S. consumers, is between $60 to $80 a barrel. When oil starts getting to 90, 100 or higher, it starts acting as a tax. And consumer discretionary income drops, people drive less, people carpool more, people don't buy SUVs, so the car companies would crash. You know, guys, Ford already has junk bonds. And Ford makes really good margins for a auto company off their pickup trucks and SUVs because they stopped making the regular cars. In a high oil price environment, that would really hurt Ford even more. I mean, obviously Ford is in trouble if their debt was just downgraded to junk. No, stagflation means that people's standard of living are being destroyed with higher cost of living and taxes. So you have the value of the currency. It's not in hyperinflation. There is not high velocity of money. And stagflation means that your standard of living is falling, 8 to 14% per year. You're losing that. And then you're getting taxed more too. RJ says the drone attack will not impact oil supply. The 50% reduction in supply will be fully restored by Monday. RJ, if you are correct and that happens, then oil is back in the bear market. And the next 2 years, 3 years are going to be very, very bad for the U.S. oil industry. Especially the deep water offshore drillers, especially the shale oil producers, and the service companies. Those share prices do not look good. The refiners benefit from cheaper oil. The U.S. has always had a strategic petroleum reserve. The U.S. has had one for a very long time, I think since even before World War II. Negative interest rates are a tax, so are high interest rates. High interest rates are a tax, negative interest rates are a tax, and so is stagflation. And so is a high oil price. High interest rates are a tax, too. I mean, if the central banks haven't interfered, there would be high interest rates already, and the global economy would have already crashed. And there would have been lots of bankruptcies, and the zombie companies would all be dead. No, that's not true. The interest rates reflect how much inflation is coming? No, in a free market they would. When you have intervention with central banks, that's not true anymore. Central banks have a monopoly on interest rates. Central banks manipulate interest rates with their QE programs and other things. Interest rates do not reflect how much inflation is coming, especially in developed countries like the US, European Union, and Japan. So it should be an interesting week to see what happens with oil prices. This is why central banks should not have control over the money supply, and they should not have control over interest rates. Interest rates, or the cost of capital, are some of the most important things in the entire economy, probably the most important things. And control over interest rates is a price control. So central banks have a price control on the most important thing in the economy, and yet capitalism gets blamed for everything. I don't think low oil prices affect the dollar at all. If there's a crisis, more money will come into treasuries and more money will come into dollar-related investments. The U.S. doesn't have fully negative rates yet, so there is money coming in here seeking higher yield. Okay, let me look at listener questions and comments a little bit more, and then we'll shut things down. I have a bunch of articles if you want to go in depth on this more. But we rarely get a Goldilocks price on oil. I have a video that I did about 2 years ago, maybe 2.5 years ago, where I talk about that the global economy needs a Goldilocks oil price, but we rarely get it. And a lot of the reasons we don't get it is because of the papers futures market in oil, and there's a lot of manipulation in the oil market too. Oil always booms and busts now, and I think the futures market and the manipulation increase things up or down a lot. We're at a stage now, Goldman Sachs disclosed this, where I'm not sure if this had ever happened in the past prior to the last 10 years, where Goldman Sachs decided, because oil tankers were cheap and they thought oil prices were going up, in 2008-9, where Goldman Sachs was actually leasing out oil tankers, buying oil futures contracts, taking delivery, storing the oil offshore in oil tankers, and waiting for the oil price to go up. So that's, as far as I know, that has, prior to the last 10 years, that had never happened before in the oil market. So there's the potential now, with these large investment banks and no position limits in the oil futures contracts market, to do stuff like that, and for other manipulation. There's a bunch of speculation. There's entire hedge funds that do oil speculation with oil futures contracts and other trades on massive leverage. There really shouldn't be the need to have massive amounts of oil futures contracts. There's just entirely too much speculation there, and that's what drives the price up too high or too low. Yeah, I'm not sure if the bond markets are telling us any reliable signals at this point. They're so rigged. There's so much manipulation in there. Central banks are... When you have governments talking about issuing 50 and 100-year bonds, you have the U.S. still talking about it. It's been mentioned a bunch recently, just in the last couple weeks. Not just President Trump. I think Mnuchin mentioned it again, at least a couple times. Japan has discussed this. We're just getting even more absurd here. Theaters of the absurd, Twilight Zone, Bizarro World, dystopian. Yeah, who knows if the drone strike was rigged or not? Who knows? Professor Curtis says the Saudis just increased their oil production. Well, that's because at a low oil price, Curtis, the Saudis need to make it up on volume, because like I said, the Saudis need oil at $80 to $90 a barrel to balance their government budget, and also their social program spending that they've promised to their citizens. So the Saudis, when oil prices are low, the Saudis then will cheat. OPEC is very, very famous for never abiding by their own quotas. It's very routine for all OPEC, almost all OPEC members to cheat on their production quotas. It's been happening. I've heard stories from professional oil traders in the futures markets and pits over the years about like all kinds of crazy stories of large American and European oil companies buying black market oil from Iran. I've heard those stories for a long time. China put a 10% tax on American oil, but China is buying most of their oil not from the US. So they were trying to hurt the US, but most of the US's export of oil doesn't even go to China. China gets most of their oil from Iran, Venezuela, and Saudi Arabia. And this is why the U.S. is debating sanctioning the four largest Chinese banks, because they do a ton of deals with Iran. And Kyle Bass has been calling for, and I think other people have been calling for, the four major Chinese banks to be removed from SWIFT and extra sanctions put on them. Yeah, Exxon Mobil's balance sheet is not good. They have high debt to equity ratios. Exxon Mobil's claiming, their CEO just claimed in the last week or two, that they can get double-digit returns on their shale oil investments, but other than EOG Resources, no one else in the shale patch is getting that consistently. So I don't believe the CEO of Exxon Mobil. EOG Resources really is head and shoulders above every other shale oil producer. They're really, really good at what they do. I just wouldn't be, this is not financial advice, just my opinion, I would not be buying the shares now of EOG. I would wait. If the shares go lower and we see a bottom in oil, I think that would be a good purchase for EOG. It's a really well-run company. They're still making profit. They're still generating free cash flow. I looked at their investors' presentation recently, and they're generating around $300 million this year in free cash flow. Very solid. They get 17% return, EOG does, on return on equity. For an oil company, that is very impressive. They run a very tight ship. They do not waste money frivolously. No stories of Aubrey McClendon with his $100 million art collection and all that other waste. EOG does not run things like that. But I'm not long anything oil here. If I was trading professionally, maybe I would be. This is not financial advice, just my opinion. I'd be long oil exposure maybe for the next week or so just on this news, but long term, at least for the next 2 or 3 years, and that's what I mean by long term now in today's new normal, I think oil is going to have a big bust still. You got to watch to see if any of these oil producers that have bad balance sheets, the shale oil producers, can actually raise capital. I don't think that they can raise anywhere near the amounts of capital that they need to fix their balance sheets. Why are you theorizing that Saudi Arabia would leave OPEC? They're the main country in OPEC. Why would they leave OPEC? I don't see any evidence that they're leaving OPEC. There's been talk like 5 or 6 years ago that OPEC would break up, but I just don't see any evidence of it right now. Oh, the abiotic oil theory. RJ oil is an infinite resource generated from decaying plants trapped within the Earth's crust and is not a fossil fuel. Is this true? Well, fossilized algae. That's what most of the people believe. Oil is a finite resource. There's people that believe in abiotic oil, but there's a lot of the oil companies, if the abiotic oil theory were 100% true and there was massive amounts of abiotic oil, then the oil producing countries and companies would easily be able to restore their reserves, and the data just doesn't show that. So there may be some abiotic oil wells, but they're tiny on a relative basis, and they cannot replenish everyone's oil reserves. If there was unlimited abiotic oil reserves, why haven't all these oil-producing companies and national oil companies magically replaced all the reserves? How does this affect the gold price? In a geopolitical event, the gold price should rise, but who knows? in the past, geopolitical problems have meant higher gold prices in US dollars. But that might only be short term. I think long term, I've still said 6 months, 12 months from now, we're going to see a higher gold price in dollars. That's my opinion. So I think abiotic oil, that there's unlimited amounts of oil, I think it's untrue. There may be some abiotic wells, some small amounts of oil production, but all oil wells do not magically replace. I know there's people out there that claim that. There's one of these guys in the alternative media that's on the Kaiser Report all the time. I forgot the guy who says that. Okay, I'm looking at listener questions and comments. Most petroleum geologists think that oil is fossilized algae, not dinosaurs. And there has not been a lot of big oil discoveries. So they're not replacing the oil produced. So 20 years from 15, 20 years from now, we're going to have a big problem. Shale oil has been subsidized. It's not economic. Most of it's not economic. Other than EOG's production. EOG has been consistently profitable in bull market, bear market, sideways markets. But the other shale oil producers have not consistently been profitable. So, do you still think that there will be a big oil bust 6 months from now, a year from now, 2 years from now, 3 years from now, or has this news with Saudi Arabia changed your mind? Yeah, the U.S. doesn't import nearly as much of their oil from Saudi Arabia. It's China who imports most of their oil from Saudi Arabia. So this would hurt China more. Oh, and Neocon forgot about this. Neocon Lindsey Graham. Guess what he was on Twitter doing earlier on Saturday? He was on Twitter earlier on Saturday demanding that the U.S. retaliate now and bomb Iranian oil facilities, including their refineries. Gotta love neocons being neocon-y, right? Dave asked, what kind of beer am I drinking? I just finished my Corona Familiar. It's a little bit darker Corona. It's pretty good. Yeah, I'm not a fan of Lindsey Graham either. But who was Lindsey Graham's mentor? John McCain. Modelo Negra is your favorite. Yeah, I think Corona Familiar. I think Modelo and Corona now are the same company. I think they merged. Yeah, Lindsey Graham's mentor was, you guessed it, John McCain. So we'll see. This week should be interesting. There should be fireworks. Watch this. They cap the gold price. The gold price actually goes down and oil goes up. I'm not sure what the next live stream will be about. I haven't thought about it yet. I was just planning on talking about how Russia is preparing for $25 a barrel oil, and I don't think even a crisis scenario that oil will go to $25 a barrel, because I think if oil goes to $35 or even $30 a barrel, I think there will be so many bankruptcies that will force prices higher. So I don't think we're going to see $25 a barrel again. We didn't even see $25 a barrel in 2008. We saw $29 a barrel. The current energy return on energy invested in oil, it's very bad, especially for shale oil. Without the artificially cheap capital and debt, and the Dallas Federal Reserve ordering a lot of the banks to not call on the debt covenant breaches for a lot of the shale companies a number of years ago, there was a Zero Hedge story about it. I think there would have been even more bankruptcies in shale. And then also the pension fund managers, I talked about this. To be brutally honest, I think there's a lot of incompetent pension fund managers and they pinch pennies. So either these pension fund boards with firemen, policemen, teachers, government employees, they try to pinch pennies and then they get raped and pillaged by Wall Street investment banks, hedge funds, and private equity on bad deals. They lose millions, if not billions of dollars in bad deals and bad investments, and Wall Street investment banks take ridiculous amounts per year in fees. And if these pension funds that manage many billions of dollars, if they actually hired a competent person like me or other people, and then they actually paid us a decent salary instead of indexing everything or agreeing to bad deals, they would actually have good returns and they wouldn't have as many bad deals. But they don't want to pay people like me even $65,000 a year. They would rather get raped and pillaged and lose $90 million per year on some of these pension funds in fees. So to save a couple $1,000 and not pay someone like me who's competent and can tell what a bad deal looks like, they would rather listen to a Wall Street salesperson, make the investments themselves, and then lose tons of money on bad deals and then also get pillaged on fees. The pension fund, the calamity in pension funds in the United States is a total disaster. And then they will, of course, go hand in hand they will either jack up property taxes, they will lobby the state capitol. And remember, these pension funds are legally, the retirements for these pension employees, a lot of them, if they're government employees, are legally guaranteed. So the state of Illinois tried to get out of this mess with their pension funds, and the pension fund sued Illinois, and they can't reduce the pension fund guarantees. RJ says, 100% agree on the stupidity of pension fund managers. They rely on Wall Street commission machines. Yeah, so some of these pension fund guys are on the take. They're bribed. They're bribed by Wall Street investment banks, and some of them are just incompetent. Or the pension fund board will not hire a competent money manager. It is a big mess. And it's not just pension funds in the U.S., it's pension funds in the European Union and elsewhere. We're going to see what happens with the pension fund problems in Illinois, California, and elsewhere, because Illinois is a big mess. Illinois thought that they could just increase property taxes on working class houses and middle class houses, and they could increase property taxes another $5,000 to $8,000 per year, and no one would complain, and it would be no big deal, and it has backfired. But the pension funds funded, besides central bankers manipulating interest rates lower, and that helped fund the shale boom, the pension funds also were big suckers in this. There are some good pension fund managers, but most of the pension fund boards are not willing to hire competent people. They try to save small amounts of money on fees, and in long term, that screws them over. So trying to save small amounts of money in the short term will screw you over long term. You think oil will get over $70 pretty quick? That's interesting. They would have to go up a lot to get over 70. Well, Brent crude, it wouldn't have to go up that much, but for WTI, it would. WTI, it would have to go up over around $15 WTI. Brent crude would only have to go up a little under $10. So I'll just read this oilprice.com article by Julianne Geiger from a few days ago. Russia considers possibility of $25 a barrel oil next year. Russia is considering the notion that oil prices may be as low as $25 per barrel in 2020, the country's central bank said in its new forecast published on Monday, as cited by Reuters. Russia's central bank has forecast in its macroeconomic forecast that oil could possibly hit that low due to falling demand for oil and oil products worldwide, as well as from disappointing global economic growth. The doom and gloom scenario was just one proposed by the bank. If that risk scenario actually materializes, Russia's inflation could increase to 7 or 8% next year on the back of falling GDP down to below 2%. Russia is perhaps uniquely positioned to withstand low oil prices, although $25 per barrel is pretty bleak. One of the reasons why Russia is more impervious to low oil prices compared to its competition is that its currency weakens when oil prices fall. This provides some type of a cushion, at least to some extent. Actually, it increases inflation in the Russian economy. So it would make their goods from a mercantilist point of view, neo-Keynesian point of view, more competitive. By devaluing their currency, it would boost exports from a Keynesian point of view, but it would put a lot more inflation into their real economy with a weaker currency. This provides some type of a cushion, which I don't agree with, at least to some extent, for low oil revenues. Russian oil companies can pay their expenses in the weaker ruble, but still rakes in US dollars for oil exports. Further allowing it to withstand lower prices are that Russia's oil companies' taxes are designed to be less as oil prices fall. So much so is Russia's ability to adapt to lower oil prices that it actually struggles with higher oil prices, which dent demand for its oil. Well, I've already discussed this, that if oil prices go too high, then that curbs demand and it acts as a tax on the global economy. It reduces consumer discretionary spending, etc. Savings that consumer has because they're paying more money for gasoline each week. Russia's budget for 2019 was based on $40 per barrel oil. Meanwhile, Saudi Arabia needs $80, some even say $85 per barrel, to pay for their social programs and their government budget. In August, Russia said its 2019 budget break-even was at below $50, $49.20 a barrel, the lowest break-even in more than a decade. This has Russia and Saudi Arabia colleagues in the current production quotas designed to rebalance the oil market at odds and likely working towards perhaps different goals. No, I don't know if the fires were fake. We don't know if the fires were fake. I mean, I'm sure there's going to be articles that the fires were fake. We don't know yet. We may never know the truth, but we definitely don't know now. I mean, Saudi Arabia is not exactly the most transparent government in the world, right? So it's going to be an interesting week with oil price. I still think the bear market in oil will start, but we'll see. I mean, the bear market in oil will accelerate. We already have a bear market in oil. Just look at the share prices of the deepwater offshore drillers, the oil service companies, the large ones here in the U.S., and then also the shale oil producers. We already have a bear market. Yemen is pissed. Well, the Saudis have been bombing Yemen. The Saudis have been funding this war, right? Saudis have been attacking and bombing Yemen for, what, 2 years now? 3 years now? It's been a while. I don't smoke, and I'm not vaping. They can provide from other OPEC members. I'm not sure how much additional capacity the other OPEC members have. It's been widely accepted that the Saudis have the most spare capacity of any country in OPEC. The Saudis have a lot of spare capacity. Okay, well, we're almost at an hour. Thank you, everyone, for my super chats. Thank you to Tarquinus, Matthew for 2 super chats, and Lee. Thank you very much. And thank you to my almost 150 now Patreon account contributors. You guys are making my life a lot less stressful. I can think about creating content and growing this channel out. Getting to almost 30,000 YouTube channel subscribers. That's my next major goal now that I'm over 5 million views. My birthday is coming up in a couple weeks, and I'd like to be over 30,000 YouTube channel subscribers by then. We'll see if it gets done or not. I'm hearing the YouTube algorithms are starting to crack down again. My channel was growing at 2,000 new subscribers per month for months now, but looks like it slowed down a little bit. And thank you to my almost a dozen now monthly PayPal account contributors. Thank you very much. If you tipped on the super chat, thank you. If you don't have any money, that's fine. I realize times are tough for people. Just hit the like button if you like my content. Look, until I see otherwise, I am very convinced that the oil market is in a worsening bear market. With the share prices, with the inability for a lot of these shale companies and others to raise as much capital as they used to, they're going to have to live within their means if they don't go bankrupt. So I think we're going to have a big bust in oil, especially in shale, in the next couple years. The deep water companies are looking really, really bad, especially Transocean. That's looking like a disaster story with that bad acquisition and their balance sheet problems. And then the oil service companies, which normally the oil price isn't at $30 a barrel, and we have shares of Schlumberger. Let me just take a look here real quick. Yeah, the oil market's not even at $30 or $40 a barrel, and shares of Schlumberger are down a lot. Okay, guys, well, that's it. Bye for now. Thank you for listening, and we'll see what tomorrow's video is about.